Okay. Right. So this we have done. I don't know if you guys get time to revise. If not, revise today, and if you have any questions, we can discuss this again. We have done this chapter. We discuss about lease and revenue also. Provisions also we did. Did we do provision?
Yes, we did.
So in provisions, we need to understand again the definition. That IAS 37 says that obligation can be legal arising from contract or it can be constructive. Know the definition. I would recommend you just write it few times. Write and understand the logic behind it. And obviously, why we have this IAS, IFRS standards? Technically to make things easier, not to make it complex. And secondly, we don't want managers to use the loopholes. And it should be very clear. It should be transparent, and it should always help to compare. Right? So these points are important for us to remember. Then after this chapter, we'll start with intangible asset. Okay, intangible asset is important for us. These 3-4 standards are important for us. So firstly, what is intangible asset? Technically, if you even start with the basic asset, what is asset? We have property, plant, and equipment. Then what is happening with the time? The entire businesses, they are going from tangible to intangible. The demand for intangible is increasing. For example, in Ressett, we say we have 40 years of experience. What is that? It's an intangible, right? We have created a goodwill. That is an intangible. Even for the companies that are product based, that are into manufacturing, for them also intangible asset has become extremely important. If you do a business valuation, let's say a buying and selling is happening about a business. Okay. So in that case, what we do is, let's say manufacturing company, we used to add up all the vehicles we have, the plant, whatever the cost is, that will the business valuation. Let's say they have 10 asset and each asset is 10,000. So the value of business 100,000. But now the same business with the same asset, 10,000, it's not 100,000. Maybe it's 50,000. Why? Because they have got a goodwill of this 40,000. They have got patents of this 40,000. They have got forward contracts, like future cash flows. They have got maybe the contracts, a lot of other things. It was there previously also, but things are changing. Even the manufacturing company, they are getting more intangibles. We'll see more of business valuation in F3 next level, but intangible asset is very important. Previously, it was considered mostly for the service industry. If you see in service industry, 90% of the asset is intangible asset only, right? It's not a physical product. Like it's a hospital. So what is the intangible asset? We cannot see the service. Most of the things are what? Intangible. But if you value that by adding all the physical asset they have, it might just show 5%, 10% of the actual value of the thing, isn't it? Are you getting the point? Therefore, in order to value it correctly, we need to have an intangible asset. And why you want to value? First is for buying and selling, and secondly, it's also to give information to our shareholders. Like if you see in our pre-scene also, they have given our intangibles, right? How much was it? Let's go back to that. And if you see, intangible asset is 2.2 million. Can you see? And if you compare this with fix up, fix up has 1.5 million. So almost here they have like 1.5%. of their PPE, and for us also it's a good percentage. Despite we are into product. If you see, we are selling physical product, right? But still we have an intangible asset. So intangible asset is important for every business now. But the problem what happens, many times companies can exploit that. Anything and everything they will put as an intangible asset. Okay, for example, let's say in Ressett we are doing some research and development. Okay, and research and development is not achieved, it's not successful. We have got maybe something basic, and we are putting into intangible asset. So what will happen? We are giving wrong information to the shareholders, to the stakeholders. Therefore, this IAS come in. It will be very, very specific. What will fall under intangible asset, what will not fall in intangible. That doesn't mean that you put anything into your research and development. You bring in anything and you say like, okay, this is an intangible asset. Maybe you have got some license which is not beneficial for us in any case, and you want to add that up into our intangibles. That is not allowed. There are certain categories that it need to justify, satisfy, then only it will be part of intangibles. Because many times what happen when, especially with the bigger companies, when they invest so much into R&D and research and development, mostly, most of them doesn't achieve the desired result, right? So what will happen? That money they are tempted to show in intangible asset what they have created. But if you see practically, that is just an expense for the year. So what IFRS says is, if you have invested into research and development, you have not achieved and you don't qualify as per IAS 38, so straight away put that as this year expense. But if you put so much money as expense for this year, what will happen? Your profit will go down. If your profit will go down, it will give a wrong, or we cannot say the word wrong, maybe it will demotivate the shareholders. They say last year the profit was good. This year, maybe despite higher revenues, the profit has gone down. There is something wrong. And it can affect our ratios also. So they want to bring into intangible asset. But if they bring in intangible asset, they are misleading, because this money they have invested, it doesn't give any return. Does it make sense? So what question can come from here is whether it qualifies intangible asset or not. So there are certain conditions, you just have to memorize that point. Clear?
Okay.
It's very simple. Okay. IAS 38 intangible asset. So the number here is 38. Number is good to remember. Sometimes they will say what qualifies as IAS 38 intangible asset. Sometimes they will just say intangible asset. So if they don't use the number, it's good if we can remember it. So IAS 38 intangible asset sets out the principle for how entities should account for asset they lack physical substance but hold value for gathering future economic benefit. Very good sentence. I'll read it again. For how entities should account for assets that lack physical substance but hold value for getting future economic benefits. Ultimately, it should bring in the future economic benefit. It provides a framework. What is framework? Framework means a set of rules to ensure consistency, transparency, and comparability in financial reporting when dealing with items such as intellectual property, software, and other non-physical resources. Because this problem is not there with the physical resources. The standard emphasizes clarity in recognition and measurement, helping organizations present true and fair view. It should be beneficial for them also and for other stakeholders also in their financial statement. IAS 38 highlight the importance of treating intangible asset with the same rigor as tangible, while acknowledging their unique characteristics by setting clear boundaries on recognition and measurement. The standard helps organizations avoid overstating value, ensure that physical statements reflect a balanced view of both physical and non-physical resources. Ultimately, what we are trying to do is make something which is true and fair, reliable and comparable across entities, And where we are taking decisions from, the data is this one. If we give wrong information, it can also affect our decision making. Not only us internally, but the investors, the regulators, all other stakeholders will end up taking a wrong decision. So what is IAS 38? It is an intangible asset and identifiable non-monetary asset without a physical substance. What it includes? License, quotas, intellectual property, patents, copyright, brand name, trademarks. Can you think of some intangible asset what we have in Ressett?
Goodwill.
Goodwill we have.
Maybe we have software to check like that we are using in deleting a data or something, some specific
Yes.
software we have.
Competency is a goodwill, intangible asset, right?
Sorry?
Business competency.
Yes. We might have the license to operate. We might have got some special quotas when we are buying the products, maybe. That can also be intangible asset for us. In fact, in our business, the advantage we have over others is intangible asset. Otherwise, I don't think a new company coming into this sector, they'll have any problem to invest the finance, isn't it? Financially, it's not a very big business to get into. Entry wise, if you see, let's say a other company from different industry, they want to come and do a similar copy or business model. It's not a major problem, right? If you look at the tangible, what they will struggle is the intangible part. An asset is identifiable if it is both separable and arise from contract or other legal rights also. Separable means separately also it should have a value. This license should have value separately also. This patent should have value separately also. It is not attached with the physical world. Then arise from contract or other legal rights. We can have a legal right. We can give a contract with them, or we have taken by a contract, or we have a legal right to use it. As a result, goodwill arising from the acquisition of business is not accounted as an intangible asset as per IAS 38. It cannot be sold. So this is a very important point. If something cannot be differentiated from that physical asset or from that business, it's not part of IAS 38. It cannot be sold individually without disposing the rest of entity. Therefore, it is IFRS 3 business combination. It's not IAS 38. So IAS 38 does not consider goodwill.
Misbah, in our case, development cost is also treated as a intangible assets, right?
Development
Like
cost,
direct.
no. Cost is an expense. What you have
Yeah, but
developed,
over the period of time we can amortize
no.
in the intangible assets because we
Amortization
have a
will
direct
come. Okay.
staff cost
What I'm trying to
for
say here
system.
is it should be separate. If you're saying development cost, then you have to show what you have developed.
Like direct staff cost, we have a direct staff cost in some system development. So over the period of time
System,
we can
you're saying
amortize
software.
there.
That amortization will come later on. First, we are talking about identification. If you have developed a system like software and it qualifies the two condition, it's separately also we can sell it, or at least we can separate the software. Plus, we have the legal right to use it. It's our own. Then you can identify.
Okay.
And what you're talking about amortization is just like depreciation for intangible asset. For physical asset or tangible asset, we call it depreciation. And for intangible, we use the word amortization.
Right, right.
Accounting for intangible, if you see goodwill, internally generated intangible asset should not be recognized. Why? Because it's not identifiable, it's not capable of reliable measurement. If it is separate any intangible asset, recognized at a cost if recognition criteria met. So we can also purchase. It's not always that we have built it in-house. Like here they have given an example of software license, a patent. Let's say tomorrow we have started making our own laptops. I think making laptops can be easier than the phone because the competition is so high in the smartphones. So for that, we have acquired a certain patent that will be recognized as under the intangible asset. If you see for us from last year to this year, we have not done anything as such. So our intangible has remained same. Internally generated intangibles cannot be capitalized as they cannot be identified separately from the costs associated with running the business. The following generated intangibles can never be recognized: goodwill, brands, publishing titles, newspaper, customer list, because this is part of the business. It cannot be separate. If you have purchased from outside, it's separable. Yes. Now, how we measure it? So there are two things. One is the cost model. Second is revaluation. Cost model is simple. The intangible asset should be carried at cost less amortization and any impairment loss. So technically, you have bought it for a certain amount and you'll have amortization. You know, if it is going down, usually it will reduce in value. You have to reduce that, and whatever is left, that is the cost of it that you can put into the financial statement. If you think like there is certain asset which is indefinite useful life, then we don't need to amortize. It will be tested for impairment annually and more often if there's an actual indication of possible impairment. The same thing is given into the chart. What is the revaluation model? Intangible asset may be revalued at fair value. What is fair value? Fair value usually referred to a market value. The active market exists where all the following conditions are met. Items traded in the market are homogeneous, they are same. Why we need to have all these details? Because to get a transparent and exact amount. Willing buyers and sellers can be found at any time. Price are available to the public. If it is not same product, if it's very difficult to buy and sell, price are not public, that means it can be manipulated. It's not a fair value. But at the same time, they are mentioning, I state that active market for intangible assets are rare. Specifically prohibits the revaluation of patents, brand name, trademark, and publishing rights. For example, some of them can be taxi cab licenses, farm milk quotas, specific to that. De-recognition, we can dispose of also. Is de-recognized on disposal or when no future economic. Let's say we have a license, but that expire. Let's say we have taken license and now in 26 September it will expire. So our 2.2 million intangible, let's say it was for 0.2 million, 200,000. So what will happen? It will reduce to 2 million. That's very simple. Usually an R&D company wants to bring in a lot of intangible asset to show the shareholders and the other stakeholder or justify the cost in R&D. They want to keep on improving their intangible. Development expenditure can only be regarded as intangible if it meets the criteria of IAS 38. If the criteria are not met, the cost must be written off as research cost, as I said in the start, as an expense in the P&L, profit or loss. Capitalized development costs are then amortized over the product's expected useful life. Maybe we can use that this six criteria also able to use or sell. We should be able to use it or we should be able to sell it. Should be technically feasible, intent to complete. If it is a work in progress, adequate resources, we have to complete it. Reliable cost measurement we have from the market, and it should give a benefit, future benefit, or we can say economic benefit to the business. That's it. It was quite simple. Any question?
No, Mr. Just like what is different from my understanding, there is no goodwill will be a part of IAS 38. It would be a part of.
Goodwill is generated internally? No. If you have bought from outside and it qualifies a definition that you'll get a future economic benefit from that, it can be sold separately. Yes.
But in case of any company, like let's suppose they said we have a goodwill of like we have a goodwill and we know that is a customer base, it will never go to buy to someone else buy our products or something, like there is no one as a competitor and we are selling our company. So will it be a part of IAS? Like it's gonna be as a IAS 38 because we are selling it and we are asking for more money than the
No,
assets.
because we have internally done. That's a business valuation totally. You
Okay.
cannot show it separate.
Okay.
Just remember two things. This is very simple chapter. IS 38 will recognize only in two conditions. One is it is probable that there will be a future economic benefit. We'll get money from this first. And second, you can measure it properly
Okay.
with the market price or whatever you want to do it.
Okay. So other goodwill would be a part of valuation only. Okay. Thank you.
Yeah, it will help the business.
Misbah, there is that for this IS 38, they have that short form is there for that, no, for the word pirate, which we use, right, to identify the six criterias. Like P stands for the probable future economic benefits, I for the intention to complete, R for the resources.
Yeah, this is the six criteria.
Yeah, A is the ability to use or sell, T is technical feasibility, and E is economic expenditure measured reliability. I mean, what you said in short, the two are more important, basically.
Yes. I, I think I can share that also. You can learn that maybe in that shortcut will help.
Yeah. So just to remember when you IS 38, you remember the word pirate, like you sort of understand what it is. You know?
Can you just put it into chat or message, Anthem?
Yeah,
I'll also,
I will put it. I will put it.
yeah, I'm glad you're remembering it. These shortcuts are very important. So I studied just this shortcut is fine. Rest all is theory. They'll ask question only from this. If it qualify or not, you have to see this 6 point, then we are done. I'll also put in the group. Yeah. Pirate, you can remember. I've just messaged on the group also. Let me write the number. Do you guys want to take a 5-minute break before we start the next chapter?
Yeah, miss, but 2 or 3 minutes would be also fine. Like not just 5. It's fine. I'll just go in back in 2-3 minutes.
Yeah, take 5 no problem.
Okay.
எடுத்து போட்டுக்கலாம். நான் அப்புறம் புக் பண்ணிக்கிறேன் எக்ஸாம்.
Hello? It took little more time. Are you
Yeah,
guys back?
yeah, I'm back.
Yeah. Did you go through this pirate?
Not
Just
exactly.
memorize
I
that.
just checked.
So if you do this, IAS 38 is done.
Okay.
Things become very simple then. All right. So next one is income tax. I don't know if they will ask any question from here, but we can quickly go through it. Income tax from CIMA F2 perspective are viewed as essential element of financial reporting that reflects how organizations account for obligations to tax authorities and the impact of taxation on reported performance. So technically, the logic remains the same. We need to give transparency and consistent in the financial statement. So we need to show how much money we owe to the income tax, what we have paid, and what we owe in. Obviously, we have direct tax, indirect tax, and a lot of other things that come into as a business, especially when we are doing international business, when we are listed, and all of other things come in. The compliance just goes up. The income tax cover the general principle of accounting of tax. Okay. The income tax expense in the statement of P&L is an expense, so obviously it will come in profit or loss, or we can say profit and loss. Typically consists of three elements: current tax expense of the year, under or over provision related to the tax expense for the previous period. So if you have seen provision last year, I mean the previous chapter, the same thing we can have some provision. Provision is like a liability. Okay. And third thing is deferred tax. So you just need to remember these three things. What is part of IAS 12 income tax? Current tax, provision, and deferred tax. The probability of this topic being asked, I think it's very low for us. Okay. What is current tax? Very logical. Current tax is the estimated amount of tax payable on the taxable profit of the enterprise for the period of taxable profits are the one on which tax is payable, calculated in accordance with the rules of local tax. For example, here, what number we have got for Ressett? How much we paid? 2.7 million. So how we arrived at 2.7 million? For last year we paid 2.3. So this has gone up. Even we can just calculate the percentage. I think we did last time. So that is like current tax. It become debit, income tax expense, and credit liability. We don't need to do debit credit entry. Just for understanding. Then provisions, the second part. Income tax for the period is accrued in one financial period and then settled in the next. The amount settled often differs from amount occurred in previous year's financial. And also we have different closing years. Some countries are closing in December, some are closing in March, April time, right? Then also there will be a differ, especially if you see the consolidation financial statement. So the difference between amount accrued and the amount settled is recorded in current year's income tax expense as under or over provision relating to the prior period. So how we are covering the previous year with the provision. For example, here if you see over provision, estimate tax in 2003 was 120 we recognize, but we agreed for 100. So 20 is over provision. So 20 is actually a gain for us, isn't it? We have saved $20. But at the same time, we estimated 90 and we have to pay 100. So 10 will be a loss for us. But obviously provision is approximate. Makes sense? Then third criteria of IAS 12 is deferred tax. The estimated future tax consequence of transactions and events recognized in the financial statements of the current and previous period. Deferred tax does not represent a tax payable to the tax authority. Deferred tax is the basis of allocating tax charges to a particular accounting period. It is an application for accrual concept and aim to eliminate mismatch. It's mostly many times what happen is what is accrual accounting? We have not received the money actually, but the transaction has been done or we have given the products, it's in credit, but we'll account for it. If you're accounting, you might have like VAT, GST that can also come in place. So to balance, we are using this deferred tax. Accounting profit, the profit before tax figure in the statement of P&L, taxable with the figure on which tax authority is seen. Mostly it's a taxable profit that is important for us. Let's look at the example. Taxable profit here is 5,000. Example, fines plus penalties. Accounting profit versus taxable profit. Less non-taxable income, exempt government grants. Accounting profit is 100,000. Then we have 20% tax. Anyways, so the difference between accounting profit and taxable can be permanent differences. Expense not allowed for tax. Okay, so this one is important. This is because of government thing. Government don't want companies to show a lot of expenses just to reduce their tax. In fact, this is part of OCS also. I'll show you something. I have a good example. Case study. One second. Because many times it's an expense, but government doesn't want the company should use excess of that. I believe in OCS it was mentioned. No, this is also. Yeah, if you see this one, this tax regime, so like this regulation can come in. This is just for understanding, not related to us. The following expenses are not allowed for tax purpose. What is that? Accounting depreciation, because depreciation is manipulated, amortization, impairment charges, entertainment expenditure, donation to political parties, tax paid to other public bodies. So now what is happening? This thing is actually a part of accounting profit. We have reduced this from an expense, but it's not actually taxable because the government has the regulation. They're not allowing this because many times the company will show a lot of expenses to reduce the taxes. So it will change according to the country. Make sense? Yes, no?
Yes, Mr.
Yes.
Please go through this as well. I don't know if you have read it. If not, especially this chart, we have added our own. It was not there in the textbook. So that you have an idea with the real world exam. You can just read it 2-3 times and it will make sense. Then calculation, you don't need to worry. Accounting, how it is done. Deferred tax on losses. In accordance to IAS 12, a deferred tax asset is recognized as unutilized loss carried forward. It will be taken as the next year loss in profit and loss. Then other comprehensive income. So when we revalue the asset, what we do, we take it as other comprehensive income. We cannot put that into revenue. When asset is revalued, usually the asset, especially like if you see property, it goes up. Rest all, if you look at machine, plant, the value actually goes down. I don't want to confuse you, so I'm just thinking whether you should do this or not, because not very relevant. Okay, it's fine. This much is enough. So we have done till chapter 11. Okay. Sorry, chapter 9 we have done. Foreign currency transaction is there, number chapter 10. This is not part of us because we are just operating in one business. Then 11, 12, 13, 14, 15, 16, 17. 10 to 17 is not relevant to our business, honestly. Even 18, but 18 we can quickly have a look. 18, 19 we can have a look. Okay. This one, what I'm thinking, if required, I can do a recording and upload on the drive in the coming days. If you want, you can watch, but not very much relevant to our business, because we are neither into foreign business, we are neither having a group account or subsidiary. But for knowledge, it can help. Okay. But looking at the time, I would recommend to focus on the important ones. Later on, you'll have access and you can do this. Is that okay?
Yeah.
So we can go next to the integrated reporting. Technically, integrated reporting is also for a big company, but the logic is important. Even for us, it can be relevant. So why? Basically, when we do reporting, there is a problem with that. What is the problem with the financial reporting? Let's say our CEO resigned. It's not part in the financial statement, but maybe that CEO was single-handedly managing everything, or it was the biggest advantage we have, like an individual, right? Or let's say we had always good relationship with our local community, but suddenly from last 2 years it has gone down. Is it shown in any of the financial statements? No. But will it affect our business in the long run? Yes. Isn't it? It will affect or not?
Yes.
So this chapter or this integrated reporting, this is part of F3 also. What they are trying to say is we need to do more disclosure to the stakeholder, so that they can have a better decisions. Therefore, they have used the word holistic approach. The word holistic approach is not about, we should not do financials. Financials are very important, but financial plus non-financial. We need to give non-financial also equal importance. It's not legal requirement in most of the countries, but slowly the countries are motivated to do that. For example, United Nations has come up with SDGs, Sustainable Development Goals. So technically, that Sustainable Development Goals, which companies are motivated to report on, is coming from this integrated reporting. We should give more information. We should give information with our relationship with the society. Let's say in our case, how we have relationship with the society in general, in Lamland, what they think about our business. Then how we have our employees turnover, how much employees we are having and how many of them are leaving, how it affects our business. Then what we have done for the future. It's not about just profit this year. Maybe we are not investing anything for the future. Many times we are giving bonuses to our employees just based on the current year profit. So what they will think is, okay, I don't care about the future. I'll work for 2-3 years and I will resign. I'll go to a different company. I'll switch. But the company might suffer, isn't it? Therefore, a true valuation of a business or true understanding of the business will happen if you do integrated report, if you do financial plus non-financial. So integrated reporting is a holistic approach to corporate disclosure that combines financial and non-financial information to provide a comprehensive view of the organization strategy, governance, performance, and prospects. It emphasizes the interconnectivity of various capitals. This is very important. We'll see this: financial, manufacturing, human, social, and natural. We'll see this in detail, and how they are used to affect over time. The goal is to enhance transparency and to communicate how value is created sustainably in short, medium, and long term. And ultimately, it can have a better decision making into the business. Long term value. So we are here to solve the problem or minimize the weaknesses we have in the financial reporting. Therefore, if you see in the pre-scene, CIMA would have just given us these numbers, isn't it? Why they have given us all this, 26-page document? Why they have given us about the industry? Why they have given us all this detail, the board directors? So in a way, this is also an integrated report, right? Imagine if they would have just given us numbers in 4-5 pages. Let's say our numbers and fixed up numbers. Do you think we would have been analyzing it like this?
No.
Definitely no. So that's like an integrated report. So same thing, we have to give it to our stakeholder so they have a better understanding. What is the essence here? Stakeholder understanding, primary purpose, value creation, delivery of value we discussed in pre-scene, how it links between strategy, governance, performance, how things get integrated, why we need to have good relationship with the society, environmental groups, the government. Sustainable, is the business sustainable? So sustainability usually is thought of only about the environmental performance, but that's not true. Here sustainability, we are also talking about the business, sustainable growth in profit, sustainable growth in revenue, sustainable growth in our reputation. And
Can't hear you, Mr.
hello. Hello, am I audible now?
Yeah, it's fine now.
No,
Yeah, last 2 minutes we lost him.
nobody can hear me.
No, your voice is cracking. Your voice is cracking.
No, Misbah, your voice is breaking.
Okay, 1 minute. It's give me like your internet is unstable. 1 minute. I don't stop. Yeah, is it better now?
Yeah.
Okay, let me go back. So what I was saying is the essence of integrated reporting is to ultimately give a clear picture to the stakeholders. And stakeholder is not just the shareholders, the owners. They must be primary, but other stakeholders should also be considered. Then we should be very clear what is the primary purpose of the business, what values we have promised, what is our mission, vision. Then how we are looking for a sustainable business. Sustainability is not only about the environmental factor. Sustainability is also about sustainable profit, sustainable growth, taking care of jobs of our employees, being a value creator for the society, right? Context integration, how we are dealing with society, environment, and economic factors. And this will eventually lead to integrated thinking. What is integrated thinking? That we should not prioritize only numbers or profit. It will come, but other areas should also be considered. In fact, there is some concept called 3Ps. Is there in later stage, but linked to this. They are saying that 3Ps or triple bottom line. We should not think only about 1P, that is profit. We should also think about other 2Ps, that is people and planet. If you think about people and planet, then business will be more sustainable. So we have a board IRC, Integrated Reporting Council. Just like we have this IFRS, this IRC is also coming with some frameworks like a standards. Like IFRS has a framework, what to do, what not to do, like in IAS 38 we just saw. Same thing we have in this IRC. This is for integrated reporting. What should be included, what should not be included, how much should be included, like that. What is the purpose? The purpose is to have benefit all the stakeholders and create value not only for shareholders but employee, customer, supplier, business, everyone into the system. The capital should be allocated properly. We should have more value creation over time. Accountability should increase. What happens when we give more information? Obviously, we cannot give wrong information, and we want to highlight the good work we are doing. So that means our budgets can also change. Maybe in short term, it might be difficult. However, in the medium and long term, we can see the benefits of this. financial value, social value, environmental value is the same thing with different words. Like financial value means profit, social value means people, environmental value means planet. What we need to remember is this 6 capitals. Usually, we are reporting on this capitals only. Financial capital. Financial capitals here we'll talk about what we have financially. Let's say how much retained earnings we have, what is the cash at bank. This is a little bit from our reporting itself, financial reporting, but a little bit extra on that. Our inventory. Then manufacturing capital, maybe not relevant for us because we don't do manufacturing at Ressett, but in manufacturing, they are looking at what level of automation we have, what level of machines we have, how we are coping up with the future of manufacturing. Then intellectual, this is relevant to us, like we just discussed. License, patents, whatever we have acquired, contracts. Then human capital is how qualified, how skilled our people are, and what we are doing to improvise it more. Social relationship, obviously relationship with our suppliers, the government, the local society, and ultimately the natural capital. Especially certain businesses, if they are using natural capital, how they are giving it back. For example, certain businesses like paint companies, they need a lot of water. Or airline industry, they are responsible for a lot of pollution. So if we disclose on that, we'll become more responsible. Technically, if you just look at this chart, the entire chapter is in here. However, as we discussed, this is not an legal requirement, but big companies and listed companies do that. For us, doing it may be helpful or maybe not. What do you suggest? Shall we report on these areas? What will be the advantage and disadvantage? If we start reporting on the 6, or maybe 6, we cannot do 5 because manufacturing is not relevant. Hello?
We can listen to you. Yeah, but it's depend if we have a public company or we need public.
We are not public company. You know what our size is. What is
Yeah,
the advantage and disadvantage if we do this voluntarily?
it would be the disadvantage. We need more costs involved and more time, and we need to hire more people to assess our business much different way, like how we are working socially, and maybe we need to hire people externally to give us some kind of certification or certificates or achievement kind of thing. We're doing something for socially, so it also adding a cost for us. So yeah, it's look nice if we wanted to go for public company, but if we wanted to remain a private organization, I don't think so it's a benefit for us.
Not a single benefit.
Like, yeah, it would be, there would be there would be a benefits, like if we do these kind of thing and we have, especially when we are in a refurbished business, we are doing something for directly indirectly to saving the uh, dying products and giving them a life. So it will also motivate our employees as well when they read those stuff, like their company is doing good for environment, and even for like how our performance is in both financially and non-financial way. So it motivate their employee as well. It's not just about the public. Yeah, so there is a benefit, but not much, I feel.
Right. The probability is low, but as a part of service, maybe they can ask a question. They'll say, we are thinking to do integrated reporting. So what are the points we are looking for? Like we have some points here as well. What are the strengths? How it can help us? Forward-looking information provided. New information disclosure, improved stakeholder reputation, relevant information for groups, improved efficiencies. So all of this, maybe we can get into more business clients. Remember, we have B2B clients, corporate clients. So for corporate clients, they also have a sense of pressure to deal with the companies which are more ethical. For example, why Apple reputation is getting affected by Foxconn. Foxconn is just assembling, isn't it? But they are giving to a business, to another business which is not ethical, and their reputation just pass on. So if our reputation is not good at Ressett, maybe we are not a very big company or listed, but the other company might be listed. They have pressure to deal with the companies who are more ethical. And if we do this, this can improve our profile, and they might be happy to do business. Are you getting the point?
Yeah.
What can be the weakness? Potential for bias. Reports are not audited. Potential for bias means people will misunderstand. Actually, in our business, if you see, we are adding to sustainability. We are adding extra life to this hardware. Or maybe all of this, or at least some of this product will go in waste, isn't it? We are refurbishing it. We are making something which is environmental friendly. Then too much information. If we give too much information, they will get confused. Opportunity. Increased transparency is there. I mean, there can be so many more. Opportunity can, I personally feel like it can help us to get so much more business, especially in B2B. I think individuals will not worry too much about it, right? Let's be practical. Especially people are buying a used one, they are looking to save money. Threat. Losing competitive advantage. Again, it's a perceived threat. Why? Because if you give more information, your competitors will know everything about the business. It can become a threat. Another threat can be we can attract some litigation, legal cases. Over information can attract. What else? Others can you think of? Santhan, Mr. Bagar, very silent today. Give me one opportunity and one threat. Hello? Am I not audible? Hello?
You are audible, Misbah.
Yeah,
But
suddenly
I-
everything went mute.
No, I was not sure what would be the one other opportunity. Like,
Okay, Abhijit.
Uh,
Abhijit, you are also very silent. Prabhakar, Santhan, Wali. Yeah.
voice was breaking. Sorry, I couldn't hear a lot of things. Some connectivity issue. I just restarted again.
Okay. Yeah, Mr. Bhagar, I was asking what are the opportunities and threat of doing this in Ressett?
Just thinking.
Okay. You guys can think and message on the group.
Sure.
okay.
Probability is low, but maybe this question can come. And if it comes, trust me, it's very easy to score marks. You just need to know the advantage and disadvantage. And most of that is just logical. You don't even need to remember. What will happen if you give more information about the business? Last one is analysis of financial statement. So when we are analyzing the pre-scene, if you remember, we are talking about specific ratios. And you must have seen a file of financial analysis of our research. There is a separate document. Did you guys check it? Let me show you. So this chapter is just talking about when you're looking at a financial statement, what ratios are important, why it is important, and which one we need to focus on. There is one separate file also uploaded on the drive. I'll show you. Can you see the screen? Financial analysis of pre-scene.
Yeah.
Yeah. I believe we have discussed this already. So you can always refer to it. Ideally, you should have your own analysis. That's what I told you to do in your Excel sheet analysis. On one tab of financials, right? What we are doing, which one has gone up, which one has reduced, and what does it mean? Obviously, a lot of things are not very clear. We are assuming what might be the reason of changes in certain areas. Why the market is growing in such a way. We have seen the revenue growth. What we have seen is similar to the fix-up, and it's very similar to what's happening in the industry. Okay. So the same logic or the same thing is mentioned in this particular chapter. The last one is saying analyzing financial statement. Analysis of financial statement is systematic evaluation of entity's financial performance and position aimed at providing insight into profitability, liquidity, solvency, and efficiency. We need to get more information just from the financial things. Like we do ratios, and every stakeholder is looking for different ratios. Let's say as a shareholder, they are looking at a dividend, the profit. As a bank, finance provider, they are looking at gearing ratio. They are looking at the assets we have, non-current asset, the tangible asset which can give as a collateral. Then if you see as a government, they are looking at how much tax we are paying. As an employee, they are looking at profit also. They are looking margins also. They are looking at the future plans of the business. How much we are doing in R&D, what kind of automation or R&D cost. Sometimes as an employee, they like it. Sometimes they'll think like a threat. Okay, I might lose a job if so much automation happens. So companies, I mean, this is again very generalized. They are using different models, or we can say different software. In current time, we can say they are using different AI tools also to understand the financial statements. And why it is important. What they are using, obviously, it depends on the business and what is the user's thing. The same information, every user, every stakeholder will have a different purpose. Descriptive, what happened, diagnostic, predictive. So technically, if you see, financial information is a past data. What happened in the last year, like for example, what we have now, it's also a past data, isn't it? They have closed the book, I believe in they say 31st March, and you're writing the exams when? You're writing on Feb. So technically the data you have is 11-month old, almost 11 months, right? So it's the past data only. But we have to see how it can help us to predict something for the future. Perspective, how can you make it happen, prevent it from happening? If some ratios or some things which is increasing. But one good thing they have done, you must have noticed, is they have given us two things. One is from 24 and 25 comparison. Why? So we can analyze properly. We can see that. Imagine that this doesn't exist, only this is there. Then it would have been difficult for us to say whether 203 was a good revenue or not, isn't it? But now, as we see 197, we can say, okay, that's better. Right? Because we are comparing. And secondly, they have also given us for the computer, and they have also given us for the computer also 2 years. So this is helping us for number 3 and number 4. Predictive also, prescriptive. How can we make it happen in the future or prevent it? So this financial information can help us to identify users, understand business models, gather data as a starting point. We can use numerical analysis, interpret results. Like we have discussed so many times, we are cash rich company, and the first thing we can do for any investment is use our own money. And second, what we can do is we can reduce the dividend. We are paying a lot of money as a dividend. We have got how much profit? 23.8, right? And how much we paid? 22.9. That's not a good sign, but our competitor is also paying very high dividend. And we don't know whether it was this year or every year we are paying such a high dividend. There are a variety of ratios that can be used when assessing financial financial statements. Efficiency, work capital ratios, asset turnover, gearing. We cannot do all of this because in our pre-scene they have not given us all the numbers. But whatever we can do, like gearing we can do, interest cover we can do, right? Gross profit margin ratio we can look at. You should know what are that ratios. You don't need to do the calculation, but you should have an idea what does it tell. Maybe you can remember some of the ratios like gearing, our interest turnover. That can help us to justify the answer. Let's say you are saying go for the debt. Why you are saying for the debt? Because our interest cover ratio is high. Why we are saying debt? Because our gearing is low. We can easily give collaterals. We can get a better rate. Make sense?
Yeah.
Financial health check like key ratio. You see current ratio can help us to for liquidity. Quick ratio to see obviously current asset, current minus current liabilities. Inventory holding period, receivables, payables. Visual payables they have given that we can check. Asset turnover also we can understand how well we are utilizing our asset. Working capital cycle. Technically, everyone need to know this. Even if somebody is coming from non-finance background, for us it's core. But usually, when somebody gets promoted as a manager, senior manager, the one part of the training is they have to analyze the financial statements. The board of directors, whether they are coming from engineering background, medical background, whatever it is, it's usually part of the training to know these ratios. Why? Because if they don't understand numbers, the management can be very difficult. What does that mean? So we have already applied this to our scenario. I think we are good with this. Financial risk and insolvency. So obviously, again, coming to the same point, every ratio has a different use case. Gearing ratio. A typical interest rate is paid on debt. Sorry, measure of financial risk and long-term stability shows the proportion of debt into capital structure. How much is our gearing? Maybe you can remember some of the numbers. So it can, as I said, it can help to justify. I think that's it from this chapter. This is pretty straightforward. Yeah. Any questions?
No, Mr. no, not from this.
What I would suggest, do these ratios and put in your Excel sheet this week. Obviously, till next weekend, please finish it. We don't have time. Okay. So if you can finish by next weekend, E2 also we can do it quickly and we can start the mocks. We have this statement. You can use what we have shared, but make sure you put your own also. and you should be able to explain what does it mean. For example, gearing, if you're looking at profitability, we are looking at change in percentage or interest cover. But what does it mean? That is important. If you just write one point, one number will not get marks in the exam. It's a descriptive exam. All of these points have been highlighted also in the document. Okay.
Okay.
So for tomorrow, we'll start with the E2.
Okay, Misbah.